Hello, everybody. This is Roy. I am the founder of Olivon Investments Incorporated. You can visit our website at olivon.com. That's AALAVON.com. If you're on YouTube, I'm going to leave a link in the description below. Uh, we have an education portal that's completely free. You're welcome to come visit us at. Anyway, for today I wanted to make a quick video. I wanted to go over short selling, just explain the basics of it. Uh, when you, a lot of people don't know this, but you can actually bet that a stock is going to go down. When you do that, you sell the shares, you borrow the shares from the broker, and if your broker has shares available to short, and then you buy them back at a later point in time. So let's say, for instance, right. I'm not saying that this is a bad stock. This stock's going to go down, but I just had the stock pulled up, so I decided to use it. Like, let's say, around this point in time, I thought the stock was going to drop. I would short the stock, so I would go over, sort of like this. I'd pull it up in my order entry window. I'd enter in the shares I wanted to buy, and instead of clicking buy, and you don't click sell either, I would click short. And different brokers are different. It might say, you might click like sell short or something like that, but it's not your normal sell button. So with this is E-Trade, I would click short, and then the order would show up as that I was negative shares. So if I shorted 10 shares, it would show up negative 10, and then if it dropped, like if all of a sudden the stock went down to just $25 or something, I would go in and I would enter my order if that's where I wanted to exit, and I would cover. And in covering, you're buying the shares back, and this is some people do it to try and force the stock down, or for whatever reason. But pretty much you would think it's you think the stock's gonna go down, so you're betting against the company. The brokers manage this. The broker has to have shares available to short. And different brokers are different. One broker might not have any shares available, and you might be able to find a different broker that does. That's a lot of people that short stocks. They have multiple accounts with different brokers. You have to have a margin account. I think I explained this in one of my other videos. When you go to open up your normally when you open up your brokerage account, you just have a normal money account, and then you have to apply for margin of privileges. I think in the U.S., pretty much you just have to have $2,000. I believe is pretty much what they want to see. The broker doesn't have to approve you, but normally most people get approved. And once you get a margin account, you can short the stock. Let's see, you can. I'm trying to think. Sometimes they might give you more leverage. Like I said, different brokers are different. Some brokers will give you, when I say leverage, that means if you only have $2,000 in your account, you might be able to short $4,000 worth of stock. Or some offshore brokers might give you 5-time leverage even. So with $2,000, you might be able to short $8,000 or $10,000. But there's a lot more risk in short selling. There's the risk of unlimited loss. The same way if you buy a normal stock, say at $1, and if it goes up to $10, you can make 10 times your money. Well, when you're shorting stock, you have unlimited loss. So if you put $1,000 into a stock, and and you hold overnight, and you wake up in the morning and it's up to $10, you can be just way in the negative. You would be what is that, like $9,000 negative. That people can blow their accounts like that. Most brokers will, if it's during normal trading hours, and it starts to go against you on a short sale, like a lot of them have they'll have a list of all the stocks that they short, and it'll normally be something like it'd be like 25% or 30% or something like that. But if it goes against you that much, the broker might automatically exit the trade for you. And it can be it can be frustrating, day trading, because these stocks, like, when you short it, it might already be up, over 100%, and 30% might not really be that big of a jump for So a lot of people try and average their shares, try and short more and get their manage, like, when I say that, like, let's say I started to short here, like, at this price there, and then it started to go against me, and say up there, I said, well, I would add to it. So instead of my average price being to where I'd shorted here, well, now my average price, it would be probably somewhere in the middle, like right. I don't know if I'm really making any sense, but yeah, that's the gist of that. Yeah, so unlimited loss potential, and and there's not the unlimited gain potential like you would have going long, because it just can only fall so far. But generally you have a pretty good, you know generally you sort of know that the stock is eventually going to come down. Normally it's doing something ridiculous, or you wouldn't be shorting it to begin with. Um, there's a You probably won't run into it, but there's a limited number of days you can hold, depending on your broker and the rules and everything. You're subject to margin calls. Sometimes, like, especially if you're holding, for a few days, you might wake up and the stock might have not gone against you all that much. Maybe it's only gone against you, 5% or something, but your broker's saying, hey, you need to add so much money to your account, or we're going to close this. We're going to close this position out, or we're going to sell some of the shares. Because we don't want to take all this risk. We don't want it to shoot up and us to lose all this money, and you don't pay us back or something in that nature. Let's see.